already included in the PBT. So we need to deduct that, right, in order to get the cash, right? So another, the loss of the non-current asset sold. So that also has been deducted because it's a loss, it's a cost, it's already has been PBT. So therefore, we need to add back that, right? We need to add back that. Okay. Another 10, the assets revaluation gain, and this is the very broad chapter. If you are familiar, if you are familiar with the statement preparation of income, right? So there's the losses, revaluations. There's a several testing method of revaluation gain or losses. So if the company, if the revaluations for first time, the revaluation is a very broad chapters. I can't talk you here. If I talk this, it will take too much time. For I just say some few points, right? Right. So the gain or losses, that is non-cash expenditure. So therefore, if it is in the income already posted in the PBT. flow statements, the methodology, and how it's gonna be presented. So you should know. So here I have shown the method of cash. You can see the different kind of the activity in the cash flow statements. The first one, the operating activities, and the second one, the investing activities, and third one, financing activities. So the almost three part in the cash flow statements: operating, investing, financing activity. So right, this is the method, so the presenting method of the cash flow statements, right? So we will see and every elements of this cash flow statement, right? Here, so you can see here in these cash flow statements for the operating activities. First, you can see here the operating activities. The operating activities, as usually, operating activity is the main activities of an or any other the long-term debt. So we can extend the way of financing. So we can see the first operating activities and how to present this operating activity. So this is the method you can see, right? So you chart and the methodology, you will be able to answer the questions, whatever the questions they given, so you can easily answer. This is the model, the picture you should recapitulate in your mind and before you exams, right? So okay, let's move. The first from the operating activities, to use the term the PBT, the profit before tax. The profit before tax is part, you can see the profit before tax is means before the tax, the profit you earn the profit, but the tax still not deducted, right? Still it's not deducted. So therefore that is called the profit before tax. But you should understand, but that interest payment, especially interest payment, has been deducted, but then hasn't been deducted still. So that is called the profit before tax. So the PBT, the terms, the tax only tax is remain, still not the tax is. So therefore you use the terms PBT, right? So the PBT you can use the adjustment from that adjustment. So the whatever that this is a model, first the PBT you have to use this PBT, the profit before tax. So there should not be deducted the tax. So you should only deduct here the interest expenses. So that can also you can have this transaction here, right? The adjustments here, this is the cash flow in, but direct method is different from that, right? The direct method you know it, these adjustments you know it, the direct methods, right? Here we are seeing the indirect methods, right? The indirect method, they are, it is derived based on the profit base, you know. It's derived from the profit, the operating cash flow from the operating activities. We need to derive the profit, the consists of some non-expenses, the profit expenditures and cash expenditures and non-cash expenditure, cash income, non-cash income. So we need to adjust that profit, to adjust the profit in order to drive actual cash flow. Actual cash flow, the non-cash expenditures, if it is expenditures, the non-cash expenditure should add back with the profit, because that is non-cash expenditures that already has been deducted from the income. Therefore you need to add back in order to get the profit, because right, if it is an income, non-cash income, you need to deduct. So here we can see each and every elements and how question, right? Okay, let's move. The first, interest expenses. The interest expenses in your exam paper, right? You can see the income statements. The interest expenses may be given in your exam paper, right? The interest expenses already has been deducted for the year. For the year, this expenditure, the interest expenses for the year expenditure. So here for the year be back, right? Should be back, because it already has been deducted from the profit. So we need to should add back, right? Another comes the depreciation. The depreciations, it's also the non-cash expenditures of it already derived after deducting this depreciation. So we need to add back this depreciation in order to draw the cash flow statement, actual cash flow activity. So this already has been deducted as a cost. So we need to add back. This is not a cash expenditure. So we need to add back in order to drive the cash, right? Okay, let's move. The gain in non-current assets sold. So the gain not sold. So here you can gain the some assets. There's a profit. The profit you already may be included. So that is not be a part of operating activities, because that income it belongs to investing activities, not operating activities. So say the investing activities, that non-selling, that non-current assets, it's not as usual operating. Therefore we need to, whatever the amount, so it is gain or loss, that should not be a part of operating activities. So therefore if it is gain, that gain already included in the PBT, we need to deduct that, right, in order to get the cash, right? So another, the loss of non-current assets sold, so that also has been deducted because it's a loss, it's a cost, it's already has been deducted from the PBT. So therefore we need to add back that, right? We need to add back that, right? And the assets revaluation gain and loss, this is the very broad chapter. If you are familiar, with the preparation of income statement, right? So there's the losses revaluations, there's a several testing method of revaluation gain or loss. So if the company revaluations for first time, that are very broad chapters, I can't talk you here. If I talk this, it will take too much time. So therefore I just say some sentences, right? So the gain or losses, that is non-cash expenditure. So therefore if it is a gain, that income already PBT, so we need to deduct that income in order to deduct the cash expenditure. At the same time also, if it is losses, we need to add back that revaluation losses. So that is an expenditure, right? So gain or loss, the provision for the bad debt. So the bad debts is the terms very important. So we should know. So most of the students fail to understand, and if the questions asking from the provision for the bad debts, so the most of the unable to answer for that questions, because so they don't have a broad knowledge and how to handle this the issues based on the provision of the bad debts, right? The provision here we can see the provision of the you can see that initial customers and previous customers. So that's a different way. So we can see here, say for an example, this is somewhat difficult. Therefore, I used to give an examples. You can get the point. So here the debtor on, so if it is called on balance sheet, whatever the term that already has been deducted, that is a net value only given, right? Net value only given. So this is given. So if for an example the 2019 to 50 and 630, the value is given, right? The value is given here. You can see the value. So 450, right, and the 630, the value already has been deducted. The provision, or the provision of the bad debt is given the 10%. So the 10% is deducted in value. The balance sheet on the 2019 and 2002 values is given of debtor, right, of a company. An example, right? So you see the 450 already has been deducted this 10%, right? 10% deducted. This is a net value. If it is called on balance sheet, there's a already whatever the values of that is there's the net value. Even also the also non-current asset, that depreciation is also deducted. If it is a on balance sheet value, so same like that. So you can see this the debtor balance. This debtor balance of 450, the debtor balance, this 10% is deducted. So therefore the 450 is a 19%. Therefore the 450 19%. So and take the value this 10% to the 450, because this is a 10%. So we need to find this 450, how much this 10% for the provision for the bad debt for 2400 divided by 450 divided by 90%, you need to multiply it to 10. So you will get T value. So the provision for the bad debt for the year of 2019, the 50 value is the provision. This is an example, right? Here's the balance sheet information given, the 630 value. This 630 value already has been deducted the provision for the bad debt, the 10%. Therefore, we need to find how much actual provision for the bad debt for the year up to 2020. So Therefore, we need to calculate that the value how much. So 690% because that already has been deducted the 10%, you know. So therefore, we need to divide by 90% into multiply the 10%. You will get the exact value of the provision for the bad debt into the year of 2020, right? So 70 amount. So the 70 amount is the bad debt. So here two terms we need to use the how much the expenses for the year of bad debt, how much in the income statements we need to deduct as a expenses, right? We need to understand, right? Therefore this value, the initial value we should know. So therefore we need to find the value of the provisions for the bad debt. So the initial brought forward how much, the 50 values for the years of 2019, right? So also the 2020 how much, the 70 value, 70 value for the year of the provision. But here the changes, the differences, how much 20 higher value in the debit side. So we can get that. So 70 higher value, right? From that, so how much this two debit sides shall low, right? So we can get the 20 value that goes to the P&L, right? P&L as an expenses. This 20, right? This 20 already has been deducted from the profit. So we need to find this value. Might be adjusting these two provisions value. So they only give the provision for the bad debts and the debtor balance. So we need to find, and also the expenses, how much the expenses already has been deducted. So we need to add back because it is non-cash expenses. In your cash flow, you need to add back this 20. Add back as like a depreciation, like this is a cost. Sometimes this is not a cost. Sometimes so provision, the initial provision and the final provisions, if you compare, that may be a lower final value. So therefore there's a changes, there are some differences that gain from the provision for the bad debt. So that the gain is other income, as usually that other incomes that also has been included as an income. So you need to deduct that. So you need to deduct if it is the gain from the provision for the bad debt. There's a two terms, right? There's a two terms. One, we should be very clear, right? One, gain or losses from the provisions of the bad debts. Another terms, the working capital, the working capitals, the current assets. If it is increase, if it need to deduct, if it is decrease, you need to add back. So that is a current assets. You should get this value, the increase or not based on the balance sheet value, right? You can't take the balance sheet value. You need to add back this provision for the bad debts. You need to compare from that. You can't say, for example, in this balance sheet, you can't compare how much increase from 100 and from 630 minus 450. If you take that value, that is not actual value. You can't compare like that. So you need to compare the full amount of value before the division better deducted, right? Therefore, you need to get the full amount, right? We need to get back the full amount. How much, right? 450 and 50, 500 here, right? So lump sum, if I add back this 50, you need to get 500. So here the provision is also deducted. So if you compare the changes from the 2 years, the net value you cannot compare net value, right? Only take the full amount before deducting the amount. So therefore we need to add back that provision for the changes, working capital changes. This is for only, right? Right, we need to add back 70. How much is the 700? So you can see that now the differences between 700 and 500, 700 and 500. How much? The 200 is a difference in the year of 2020 increased by 200. Not the, you can't take this value, right? 160, you can't take this value. If you take this value, say for now 630, right? 630 minus 450, that's the value 180 only. So you can't take this value, right? You only take this value 200. They are comparing, you need to add back this one, right? The most of the students fail to get this year. So that's two terms you need to identify, right? You should be very clear. I think you understood this, right? Okay. Another one, the non expenses, right? The gain or loss provision bad debts, even is the gain you need to deduct, because non-cash expenses that already included in statement as a income. So but we assume that is not income, that is the provision for the bad debt, so that is not a cash expense, that is not a cash we need to deduct. So if it is the losses, that losses is a non-cash expenses even also, right? We need to add back like a depreciation, right? Any other non-operating incomes or expenditures from non-other operating expenses or incomes. So we only focus operating activity. Non-operating activities income or expenses, we need to adjust it, right? Okay. Let's move the capital. Another adjustments we need to working capital management. So as usual, current assets and current liabilities, only focus current liabilities and current assets, only the focus. Why the changes is used? Because of how much cash inflow, cash outflow took place in the business. So they are to find by changing. If they are changed, there might be a cash inflow or outflow. So that's what we use the working capital changes only. Why we use the working capital here? Because working capital is current assets, current liability. Non-current assets, non-current liability is not a operating, maybe income. That's maybe investment activity. So we can't focus that value. We only consider current assets and current liability, out of which some of assets are taken, but the few assets are cannot be taken, right? We can see here, right? The current assets is other than the cash, so you can't change, you can't take the value of cash assets, right? Cash, say for example, the cash assets in this cash is the current assets, right? That current, even though it is current assets, you can't take the value if on the changes from the previous to now, how much it is, you can't take that value. That's a separate adjustment, right? We can't take that value, that is finally adjusted, therefore that the cash from this working capital. So another one, so current liability increase or decrease, that is also we need to adjust it. There's a text, very important topic. The most of the students that fail to focus this point, right? So therefore they're difficult to do this the cash flow statements. Therefore I insist to you all, and please pay attention in this point, right? The tax and interest. The tax that takes up is also the liability you may see in your financial position statements, right? Tax of year first and year second, they are also given, but you can't take that changes value, because that changes value only that should be taken here, right? After the cash flow operating activities, after the working capital adjustment. So you need to find separately the paid tax. You can't use these changes from the working capital, you can't adjust it, right? Don't use that. The same study interest also, oh, you can't adjust it here, the text, right? The interest already we need to add back the of the profit is for profit P&L accounts, already how much the expenses also already deducted, that add back, right? So the first adjustment from the interest. The second adjustments, we need to find the paid interest, how much, that separately we need for like a text. So you can't use the working capital changes, right? This is very important, right? Another target from, if adjustments, after those adjustments you will get that the net cash generated from the operating activities. So this is only the direct method, indirect method, but other investing and financing activities same, both are same methods, right? So the opera only differ, that is on flow inflow, that directly calculated, but it is not a directly calculated. From the profit we adjust on cash expenses, we adjust only, right? Here we can see the investing activities. There are different type of the investing activities. Non-current asset sold value, that is non-current. So that is non-current, that is investing. So non-current assets purchase value, that's non-current assets, right? So we here, first of all, you can go back, and this I forgot to say this topic, the working capital adjustment. From the, when you do the working capital, if there's a current assets, if their current assets increase, if their current assets increase, deduct that value, is the value, right? For the inverse relationship, if they have reduced the current assets, you need to add back, right? You need to add back current assets. what to do the adjustment, right? Here the current liability is the positive relationship, right? Here if there's a current, if their current liability increase, you can increase, you can decrease. So this is the methodology. Don't forget it. Just to keep this strategy, you can easily answer them. Okay, the investing activities, the dividend. After the next one is a dividend, right? The dividend. So most of the students they are confused of the dividend received and paid. The dividend received, actually that is the investment, because the dividend you invested somewhere else. The other companies give you a dividend, that is a return to you, that is return investing. Some other companies, that is return to you as a dividend, right? So therefore the dividend is the investing activity, that if you receive that dividends, that is the income for you, that cash inflow for you, right? You need, right? The fixed deposit interest. So you sometimes you may have a cash, that cash more than your operations in your financial positions, right? You need to invest banks or some other financing companies, so they will give you interest. That interest also considered as an investing activities, right? So another terms, the investing long-term assets or recover assets or like that, any other thing, long-term assets. So that is also part of the investing activities. So after adjusting this, you will get that net cash from investing activity. So that is the value. You can go for the financing activity, right? Financing activity. So financing activity of the part, getting the fund for the organization and release the fund from the organization, that is a financing activity almost, right? For example, here receiving shares, the company issue the share for the shareholders, the shareholder get the shares and money to the share, so the money come to the organization, therefore cash inflow. Debt, so any bank loan or any other long-term debt if you receive, that is the cash inflow. So you need to get, if you pay such amount or if you release that amount debt, so you should be very clear, right? Long term debt here, you can't use the short term debt. Short term debt comes under operating activities. It should be long term. You should be very clear, right? Here the paying long term debts, right? So that is a cash outflow. So the dividend paid here, we already seen the dividend received, that's an investing activity. Dividend paid, it means the company shareholder, our company shareholders, company wants to pay the dividends for the company. So that is a financing. So it's not investing other companies, right? Our company paying the dividend for our shareholders, that is a cash outflow. You need to deduct therefore, right? So after you will get the net cash flow generated from the financing activities. So almost if you add three, operating, investing and financing, so those values, if you guess, there's a cash and cash net increase or decrease. If you get all the value, if you sum all the value, you will get cash and cash equally increase or decrease. From that value, the initial cash at the year first, before sometime may be given in your paper, exam paper. So the initial year, so it's 2019-20. So 19, how much the value was. So that amount you need to put here in order to drive the final amount. So the decrease increase, if you add initial amount with that, you will derive the at the year end. So this is if it is equal or your actual value in your financial positions, your cash and okay, right? So this is the part. So here we can go for the 2018 past paper. You will get the broad knowledge and how to do that question, right? Most of the students are requested to do that based on the LK7, right? Almost everybody should maintain this the presenting methods. First we need to clear these questions and additional questions. So the profit before tax and after tax for the year ending March 2018 was 600,000. Sorry, I just only use the zero deducting value, right? It is easy to do this, right? So 6,000, right? PBT, there is a profit before tax, PBT, right? The year ending is, so we need only the PBT here, it's the same, you know. So right, that's what we have, we can use it here. the 600 rupees, the zero deducting value, right? The deducting value, right? Okay, let's move on the topics. Let's move the another the adjustments to 600,000 right here. And I mentioned that after the profit before the tax and after the tax for the year ending. So the before the tax, before the profit PBT 1,000 rupees, and after 6 million, so deducting the tax, there you will get that the net profit 4,500 rupees respectively. So here, what we want to do? So the tax, we want to find the tax how much, right? Actual, this is the to get from this, right? The tax how much you want to calculate the tax how much this, right? So the 600,000 rupees that given, so that is in income statement the 1,500 rupees only. 1,500 deducted from the 6,000, and therefore you will get the 4,500 rupees after the deducting the tax. That is a net profit. So here we need to only the pay tax, right? We need to here tax how much, that pay tax how much, not the tax for the income statement. We only that is income statement profit tax, that is indicated the actual cost, the tax cost, but we need to that is not a cash, that is not a case, but we need that the pay tax how much. So therefore we need to do the additional calculation in order to find such the tax payments, right? We can go for, and this any other method can also be used, but I can say that two types of the methods and how to find that. So first, this is a T form method and how to do. So for the years, how much we need to find how much the tax for the year. So there's a tax here. You can see here the tax, the provision for the income tax is given 2018, 2017. 2000 is given here. 2018 was given here. You can see here the 400 rupees here, 400 rupees. So this 400 rupees you can calculate brought forward. This is the brought forward. The final, this is the 2018. How much? The provision for the income tax 500, right? If you adjust this value, the 500, the 500 and the 500, how much is given? So the profit, which side? The profit statements that posted from this is the brought forward from this here in this it goes to the income statement. In the income statement it goes to the debit side. Here already this is a P&L questions. The P&L, how to the P&L value how much? So 1,500 value. So 1,500 value. 1,500 unit add back this from the credit sides. The 1,900, right? 1,900. You can get this value 1,900. Sorry, right? This is the carried forward. But the cash actually how much faced? Cash, right? You can get the cash how much, right? That's a get such that 10400 actually cash paid. This is the cash paid value. So you can easily identify this value, right? Identify this value cash paid. So this cash paid, this is one of the methods. So you can use one method. You can easily use it. That is even also you can use it in this equation. Cash paid, how to calculate the cash paid. So this is the formula. You can use it. Paid value how much that equal. So how much you can use it. Straight. How much is the P&L? How much? 400, 500. The opening balances of the tax. Opening balance. You can see the opening balance. How much? This formula can be used here. So you can post the transaction. We can go for that from the statement, cash flow statement. You need to do this. The tax right here. The tax. The pay tax 1,400. The first adjustment we have done, right? We have done. That's a tax. Right. The second adjustment. We read out the second adjustments. The total interest expenses on the long term for the year ending 31st March 2018 was 60. The long term loan. Here the long term loan, the 10,100 and 10,500. So the value is given the 2 years value, but they given the accrual interest. The accrual interest, the interest long term loan for the year ending 31st March 2018 was 600. The 600 is the accrued interest. 600. This is an accrued interest. This 600. So the 600. This is a this is the interest, and it should come under current liability, but they added up the long-term loans. So we need to separately find that long-term loans how much. The 600, the accrued interest. In this respect, the 400 it has erroneously added to the long-term debt loan balance, the 31st March 2018. Right? Then we have to see this value, the 31st March 2018, how much. That's some value. How much? That's a 400 rupees. That's a 400 rupees actual. That is a in this for 10,500 in the 2018 years, that the 400 value also added as an interest. So what it is in presented as an current liability. So the 400 we need to deduct the 10,500. Actually, we need to compare the long-term loans if there's any increase or decrease. But there's, if we deduct 10,500, there's 10,100, 10,000 differences. Therefore, we come to the conclusions. There's no any long-term long-term loans borrowed or released. So there's no any cash outflow inflow from the loan. Right? But we need to consider that the interest, the long test. So the interest is the point we need to do additional work here. The interest we should know how much for the year interest is given here. During the year interest how much? Right? During the year given interest of the during the year 600. The 600 accrued interest they say. Accrued in this respect to 400. It has erroneously added to the long-term loans as at 31st March 2018. So there, but 400 is a accrual. So 400 is a accrual. So what we do, so we can easily get the 200 is only paid. 600 is the actual amount that is included in the income statement. That's 600 as a cost. So we need to add back that cost. We need to add back that cost right in the interest. Right here, the interest expenses 600. This is interest expenses. We need to adjust here the actual paid value. Right here, actual paid value. We can right here how much interest actually paid, because 600 for the year in the income statement 600 is posted as a expense. Actually pay the 400 they said mentioned the 400 is the accrual. 400 is a accrued interest. So the accrued interest 400, but 200 actually paid. Right, 200 paid. So therefore the paid value you should be posted here, not the entire value. Not the entire value. So here you can view this interest expenses. So initial, if there's any initial brought forward, you can assume no any initial brought forward the cost, the liability from the interest cost accounts, right? But if there's any liabilities, yes, for P&L that goes to the amount that goes to we already posted that amount how much. So right, 600. So you can balance that value, tell the value 600 both sides 600. So you will get actually there's a shortage in this debit of the release the loan. So there's no any adjustments here. So the long term done. So you need to mark. You have actual paper. You maybe you have the paper, right? So you have the exam paper. So you can that hard copy. You can from that the when you do each and every examples and as well in these the financial positions also the mark the points when you correct it, right? Another questions are the depreciations, right? uh, the depreciation, most of the questions the depreciation every depreciation. So uh, the most of the students are very difficult, feel difficult to do this depreciations and how to find, but it's very easy. Seeing this question, you see the depreciation expenses is given. Depreciation in this example, the depreciation expenses for the year ending 31st March 2018 was 250. During the year ending 31st March 2018, new motor vehicle purchased for the cash and the was revalued for the first time, resulting a surplus. There were no additional or disposal of the property, plant and equipment during the year. So here the point you should understand, the depreciation, that's a value is given the 1250. So you need to, this depreciation for the year they also given the for the year, so you need to, this is a non-cash expenditure you can go for, and you need to add back this 1000 and right 250, that's a depreciation. So right, so we need to do additional working here. So not only the depreciation they mentioned, also the purchased, there's a purchase also mentioned, so the vehicle. So we need to identify the how much that purchase. So here we need to purchase value, we need to find the 2000, the year 2017, how much, the 19,000 rupees given that the initial value of the assets. You can see the property plant equipment and rupees is given in the example, right? So at the year of 2018, 28,000 value is given here, right? 28,000 value is given. So from this value we need to get actual purchased how much. You can't take the value by comparing these changes 2018 comparing this 1928,000. So it is because there's a revaluation, right? There's a revaluation also depreciation there, so we need to adjust both. That after that you actually you can find that the purchased value how much, right? So now what we want to do, right, we need to, there's a revaluation gain. This revaluation, so first we need to do that's a depreciation. The depreciation how much? Depreciation are 102 actually. This 102.50 we need to deduct this value, right? We need to deduct this value 102.50, right? This 102.50 we need to deduct, right? We need to deduct, because actually then if you deduct this depreciation, how much actually, the how much that should be actually in 2018 after deducting for the year, right? The how much actually the depreciations after deducting. But there's a 700 and the value 700, and if you deduct 700 and 750, 750 that value, right? If you deduct that value 700 and 750, here you can see here 2018 the 28,000 also here the mentions, but there's a revaluation gain, no? The revaluation, this revaluation gain how much consist, we also consider that the revaluation gain how much, the 200,000. This 200,000 revaluation gain in this 2018 they also included, so we need to deduct this amount, we need to deduct this amount 2000. So if you deduct this amount 26,000, you will get the 26,000 from this 26,000 rupees. But it should be up in 2000, here's a 2017 19,000 rupees. This 19,000 rupees also the year depreciation, the 2018 depreciation, right? 2018 depreciation, but we need to adjust from the 2017 the value, the initial, this is the 2017 ending value, right? It means the 2018 initial value, this 2017 the 19,000 value, this is the 2018 initial value at the year beginning value, right? This is 19 for the 2018. So from this 19,000, so you need to deduct this year, this 2018 years depreciation. If you deduct that 18 700 17,750, that should be 750 for the end of the year 2018. But here the 18 how much actually 2000 26,000, but there's a changes how much. If you can get the 800 and 250, they increase the value by changing this value, increasing, that's a purchase, actual purchase, right? That is a actual, and that's a purchase. It is an investing activities, it is an investing activities, therefore we can use that is the vehicle purchase 250 value, 800 and 250 value. So the depreciation, the PPE, property plant and equipments we have done. Let's move to another adjustments. The company made a public issue of the shares during the years and paid interim ordinary shareholders. So here the interim dividends paid is a financing activity, but here is not given how much interim dividend is paid and how much the public issues of the shares, how much they did not mention in this question. So Therefore, we need to find in both value the dividend how much and the how much share has been issued. So we need to find that both value dividend and issued shares. So both are the financing activities. So we need to calculate that values, right? Okay, let's move to calculate this one, right? Right, you can see here that's the dividend. First, we need to find the dividend. So, how much that retaining in 2017? This 2017 retaining also the given in the financial position for the year 2017. The initial amount is given. The retaining 2,500 here. 2,500 is given. So from the 2,500, that is the beginning ending 2000 beginning value of the 2018. So the 2018 profit, how much also mentioned 4,500. We know after deducting the tax, we already know, right? So the 4,500, that is the profit for the year. So if you add back this, you will get how much that the retained earning for the 2018 end of the 2000 end of the 2018, right? How much the year end, the how much 2018, the value how much you will get that value to 2000 and you will get that value 7,000, right? You will get that value 7,000. The 7,000 that should be in 2017, right? It should be in 2017, right? But should be in 2017. But 2017 it should be 7,000. But here, how much that value 2017 is given in in this financial position? Also 2017 also given. How much that retaining 5,200, right? 5,200, right? 5,200. So the 5,200, how did you derive this? This is the 2018, the actual value is given. Actual value is 2018 is given, right? Here, so how much the value they are sharing the profit, that is a dividend. The value is the dividend actually paid. This is called dividend paid. So it's the 1,800. So now this is the financing activities, that dividend paid how much, that is a minus value 1,800. So the vehicle purchase also, that is a minus value, right? Don't forget to do this minus value 1,850, right? Minus value, right? Here we need to find that's how much share is issued, right? Practically here you can see here the state capital and 22,800. So what are the difference between this 18 and 22,018? That's in 2018 there's an increase, the 4,018 by comparing the previous years. So that's increase. The share issued company, the company issued and get the cash. Share issued the company and got the cash already. So therefore we need to, what we want to do, get back, because that's in cash for the organization, right? How much? 4,800 cash inflow to the organization. Another question here, the final additional information, right? The company made the public issues, and that's that is done the adjustment 5. The long term, the loan is payable from 31st March 2020. So the loan already we have seen that the loan that's a 1,100. There's no any changes actually. So we now need to consider that, right? Okay, the remaining value we need to consider. We have done from the adjustment. Now we can come from the first. That is not mentioned in the adjustment side, right? That the non-covered part we need to understand what are the changes actually. So we need to do this from the operating activities, right? Activities right here. So we have done. So working capital adjustment we want to do now. Therefore we need to compare that's the changes in the current liabilities and as well as current assets. So here the property plant equipment we have done. Inventory we didn't do this any see that, right? So we need to consider this what are the changes here. So first 8,800 rupees at the first 2017, but in the 2018 9,500, sorry, the 9,680, that's a value. The how much changes in the 2018, there's any increase in inventory. That increase should be deducted from the working capital. So inventory increase or should decrease that, right? There's a negative relationship. So therefore that 880, there's a decrease, there's an increase 880. That is because if the assets is increased, it means you purchase inventory. So cash outflow, therefore you deduct that one, right? Terms the trade receivable, right? Okay, the trade receivable, you can see here the 10,500 and 9,500 please, right? There's a decrease in trade receivable. So the receivable is decreased, is mean cash inflow to the organization. How much? 1,000 rupees. So the 1,000 rupees, that's a trade receivable. Trade receivable, how much? The 1,000 rupees. That is a another term, the cash and cash equivalents. Cash and cash equivalents, we don't need to do here. That is the end of the part. We want to adjust that, right? So here the working capital, we even if it is under assets, right? We don't need to use this. Another total assets we have done, right? Okay. Ordinary share we have seen, right? We done. So we have already considered. The retained earning we have done. So long-term loans we have done. The payable we didn't consider this one, right? The payable 8,100, 8,600. There are changes in English, right? The English, how much? The 500, right? 500 trade payable 500 here, right? We can use this in the operating activities. Trade payable, right? Trade payable. How much? The trade payable 500 increase. If it is increase, current liability. If it is a current liability, if it is increase, you need to increase. That's a positive relationship. But if it is a assets, if it is in, you need to deduct. That's a inverse relationship. So here, this is the trade payable. This is a current liability. So this liability increase. So increase this one, right? 500. So here we have done almost the trade payables done. Such profit tax we have done, right? Bank OD, the bank OD 620, right? Sorry, 2000 minus 1400. So 800. It's actually the 800, the positive value, 800 positive value in 2017. The cash and cash equivalent. We can go for the adjustments. We can add back, and that we have done, and now we need to calculate the value, that we need to sum the values, right? Okay, non-cash expenses and depreciation, this one. So if you add that one, you can get the 108.50, the value 108.50 value. If you done this one, if you done this value, right? Okay, now we can do this part, right? We can easily understand, right? Okay, we have done, right? The depreciations we done. How much this value, right? Okay, we need to add back this one, right? Here how much 100, if you increase this one 700, right? So okay, right, stop here, right? We can move here the inventory, and if you get the inventory from the working capitals, you will get that value. Here you will get that value. How much working capital? 620 positive value, right? Also here that cash paid, here the cash paid, that's a minus value, right? Right. At the same times also the tax paid, the 2000, so minus value here, right? So the minus value 400 or minus 400, and you will get 6,600, right? Here if you tally this amount, you will get the net cash flow from the activities. So the operating activities, how much you will get, if we tally this amount, 606, you will get that 6,870, the net cash flow from the operating activities, right? Here this is from the we adjusting from the profit, you will get here, let's summarize as the telling this amount all the net of operating activities from the, right? So that is an investing activities, even also the same value, investing one activities only, vehicle purchase That is net cash flow of investing activities here, right? Sorry. So it's investing activities here, the 800 minus 8250. That is only one value, vehicle basis. So another activities you can see the long-term debts. Is there any long-term debts? No long-term debts here, right? So you can here see, right? So you can see here that's a value from the financing activities is only issuing shares and the dividend paid. Issuing shares is the cash inflow to the organizations, and dividend paid cash outflow. So if you adjust this value, and you will get the financing activities, the net value, you will get the value 3000, right? 3000. So almost at this both values, tally these three values. So you will get the cash and cash equivalent increase or decrease. Increase or decrease. Here you can 600,870 first plus, and second net operating activities minus 8250, and net cash flow from the financing. So that if you tally this amount, you will get increase or decrease. So here is a increase value 1620. If you add this to 800, you will get the amount 2420. So in your financial position, it must be this value, this must be same, this value. So you can see that value, right? The how much is given here, right? The 5020 in the years 2020. So the 5020, adjust this all, 5020 minus 260, right, equal 2020, right? 2020 equal, right? We have done. I think you have understood. We have done these questions. I think you all chapter. So if you have any question related to this cash flow, you can ask me the questions, and here you can ask the questions related to the topic. We will be able to respond to your question. Thank you.